Right now, the loudest warning in the financial system isn't coming from stocks. It's coming from the bond market. And historically, when bonds start flashing red, the economy is already closer to trouble than most people realize. The bond market doesn't react to excitement, it reacts to risk. Rising yields, inverted curves, falling bond prices, these are not random moves, they're signals. For decades, the bond market has been one of the most reliable predictors of economic slowdowns and recessions, and today, those signals are lining up again. When investors demand higher yields to hold long-term bonds, it means uncertainty is growing. When short-term rates stay elevated while long-term growth expectations fall, it tells us one thing clearly: the market expects slower growth ahead. This is not fear. It's math. Stocks can stay optimistic for long periods of time. Bonds don't. Bonds reflect real economic pressure, credit conditions, debt sustainability, and future cash flows. Right now, borrowing costs remain high, corporate refinancing is getting harder, and government debt levels are reaching historic extremes. That combination has consequences. Recessions rarely arrive suddenly. They build quietly. First, liquidity tightens. Then, credit stress appears. Then, growth slows. By the time stock markets react, the damage is already done. That's why disciplined investors watch bonds closely, not to panic, but to prepare. This doesn't mean a recession starts tomorrow, and it doesn't mean markets must crash immediately. But it does mean risk is rising while complacency remains high. Buffett-style thinking focuses on one question: what happens if the economy weakens from here? When margins of safety disappear, small surprises can cause big problems. This is why patience matters. This is why balance sheets matter. And this is why ignoring bond market signals has been costly in every major cycle before. When the bond market flashes red, it's not trying to scare you. It's trying to warn you.